get this on and we're all set. So hello options traders and stock traders. I know we got a lot of stock traders in here. Welcome to the Money Show, New York Money Show 2019, and it's great to be back. It's been a while since I've been here, but I hope everybody's having a great time and learning lots of good stuff. And to add to your educational experience, we're going to talk about one of our favorite strategies called the stock replacement strategy. And we like to use it for especially events like this because you never know the level of experience that you're going to get in these rooms. Sometimes we have people who don't even know what an option is. Other people have been trading for 20, 30 years. But there's something in the presentation for everyone. A little bit of option theory, but most importantly, what I want to show you is a way that everybody in this room can become a better stock trader by using options. And I know people go, how is that possible? Well, that's what we're going to be talking about. So to introduce myself, my name is Bill Johnson. I'm currently with the Institute, John and Pete Najarian's new firm. I've been 25 years in the financial industry, always in options. 6 of those years I was on an active trader options team at Charles Schwab. I do quite a bit of publishing. I've more than 15 books. I also ghostwrite for Forbes, Fortune, and Worth magazines. I do hold a master's in economics. I went back and got an MBA in finance. Both those were from UCF in Orlando. And then finally I was an adjunct professor at FIU, Florida International University, teaching a financial engineering class in futures, options, and swaps. So my job here today is to help everyone here become a better trader or investor by using options. And I don't care if you're short-term, long-term, technical, fundamental, a blend, it doesn't matter. This applies to everybody. And you're going to see why it's such a fascinating strategy. So to kick things off, I got to tell you about my dog. I've got a very unusual breed of dog. He's a little bit of Doberman, Rottweiler, Shepherd, Ridgeback, any big breed, you name it, he's in there. Biggest, meanest junkyard dog you have ever seen in your life. So, ladies and gentlemen, meet Roscoe. Okay, now Roscoe weighs about 260 pounds. Most of that's in his teeth. And he recently made the Guinness Book of World Records as the largest canine ever to walk the planet Earth. But if you were ever to meet Roscoe, this is what you would see. 5.5 pounds of pure Chihuahua attitude. Okay, so like most small breeds, he's got a little bit of a perception problem. See, he thinks he's that other dog. And the analogy here is that this is exactly how stock investors see the stock replacement strategy. They see it as this big, scary option, and they say, there's no way I'm touching it. And it's not. It's actually just the opposite. It's a very small option. In fact, there's almost no option to it at all. And what you're going to find out is it's really, mathematically, down payment on stock with a very small insurance policy attached. So we have to get our perception straight to understand what this strategy is about. So we're going to spend a little bit of the presentation talking about that, and then we'll get into the actual strategy. So the first thing to understand, that to get this strategy, that we have to have the proper perspective. We have to understand what it is that we're looking at. So stock replacement strategy, let me just give you a brief definition of what it is and where we're heading. It is simply using a long call, so there's no nakeds, no short positions in here, to mimic a long stock position. That does not mean replicate. It is not a perfect fit, but it's really close. And to get to the punchline, we're going to be looking for a call somewhere in the 80 to 85 delta range. Now, for those of you who don't know what a delta is, it's usually an options term that shows the options sensitivity to changes in the stock's price. So if the stock rises $1 and my option rises 80 cents, I've got an 80 delta. But don't worry about that. Your broker's platform, we'll see some later, it'll say delta, look right down at 80, 85, and there's your pick. It's really simple. But you have to understand what it is you're looking at and why it works. So what are the benefits you're going to get? Well, there's a lot of them. In fact, so many of them we don't really even have time to talk about them here, but let me give you some of the basic ones. First of all is cost efficiency. You're going to be controlling the same number of shares, or even more, for far less money. You're going to get a higher ROI, return on your investment. Most of the time you'll get 3, 4, 5 to 1 leverage. So if the S&P goes up 5%, you might be making 20%. That's what we mean by higher ROI. You can have limited risk. A couple of forms that comes in. Not only is it the maximum that you paid, a little component in there called gamma. We'll look at some interesting components about that. You're going to get diversification. We can spread our money thinner because we're not putting it all into one position or into a limited number of positions. And then most importantly, we have the ability to roll. Probably the most important factor, the most important benefit that you're going to get really from all option strategies. So we'll take a look at what rolling is at the end. Okay, so those are some of the things we'll be covering. So, talked about perspective a little bit ago. We got to get our perspective straight. So what makes an option an option? Good question. Is it the fact that it trades on a broker's platform? It's got an expiration date? Has a strike price?
It's a derivative.
What makes it, it's a derivative? What makes it an option though? Touching on some of the right ideas, it's the extrinsic value or the time value. That's what makes it an option. We'll see why in a little bit. So let's say if you buy shares of stock that are trading for 100, you pay 100. There's no time value in stock, which is why it has no Greeks other than delta. Delta 1, gamma 0, always has been, always will. But you're paying for the full asset. But there's no time premium on it. But let's say you bought a $100 call for 2. And let's also say that you exercised it. What's your effective cost or your cost basis? 102. Well, wait a minute. How come the stock trader pays 100 and I pay 102? Why am I overpaying? And this is where a lot of stock traders say, see, this is why you shouldn't be messing with those options. Because mathematically, you're overpaying for the shares of stock. Stock trading's hard enough. Why do we want to overpay for it? It's a good question. Why do we overpay mathematically for the stock? That's the perception, is that we're overpaying for it, but correct. Let me give you a little analogy here. Let's say we're at the, Kentucky Derby coming up, not too far away, I guess. Let's say we're going to place our bets here. Horses all lined up at the track, and we got to make our bets. This is the time you got to make your decision, right? It's kind of like what it is for a stock trader. You got to say, oh, it's either now or never. I've got to make my choice now. But what if the track owner said, you know what, I'm going to cut you a special deal. And instead of having to make your bet now, I'm going to allow you to wait for the horses to come thundering down the track halfway across, and then you can decide. Or 3/4 of the way, or maybe even right up to the finish line. I'm going to let you wait, and then you can see if you like your horse. Would that be an advantage? Obvious. That's the advantage. It's often overlooked, but that's the advantage you get with the options. We have the ability to wait and see how the future is going to unfold. Stock traders do not get that. Okay, we get to wait and see. Facebook, what, middle of last year, 25% hit. Boeing, last couple of days. Things happen. Things that you can't predict. But the option allows you to wait and see how things are going to turn out before you pull the plug. So it's what I call the right to walk away. That's the benefit. That's what you're paying for in the option. So the call buyer isn't required to buy shares, right? I think everybody knows that. It's a right, not an obligation. But that also makes it an insurance policy. There's an insurance policy attached to these call options that we'll see. And it's very interesting. It's very easy to overlook. But they have an insurance policy attached to them, and that's what you're paying for. The insurance policy is the ability to walk away. Yeah, the stock was trading at 100 yesterday. Today it's at 70. You know what? I don't want it. Well, that's a form of insurance. It's different if I had to pay 100 and watch it trade at 70. If I get to walk away, it saved me. Okay, so it's kind of an implied insurance policy. Now let's address another important question. How much is the insurance worth? What should you pay for an option? 10 cents, 50 cents, $1? What's it worth? Well, let me show you an easy way to boil it down. Of course, we could go into Black-Scholes models and option theory and all kinds of stuff, but let me show you an easy way to conceptualize it. And the word is confidence. If you have confidence as to whether the option will be exercised or not, there's not going to be a lot of time premium. Not a very big insurance policy. If you don't have a lot of confidence, you're going, I'm not real sure about this one, you're going to pay a very high extrinsic value. Always about confidence as to whether it's going to be exercised or not. So think about this. If we have high confidence as to whether the option will be exercised or not, both conditions, yes or no, then we have a low extrinsic value. And then the reverse is true. If I have low confidence, I'm going to have a high extrinsic value. So think about this. Here's Home Depot. I'm going to be using this for a lot of the presentation here today. And kind of hard to see, but I think it was trading for about 180 up here. So let's just pick a strike down here, maybe 150-ish, in the money option. Fairly confident that's going to be in the money at expiration? Of course, it depends on the time. Let's say it's 30 days to expiration. What do y'all think? Yeah. Do we know? No, we don't know. But we're highly confident that those are going to become shares. And if we're highly confident, why do we want to pay a premium for the right to walk away? We know we're not going to be walking away from it. And so those are going to have a very low insurance premium, a very low extrinsic value. Now, do not confuse that to mean that they're not going to be a lot of money, but that's intrinsic value. That's different. That's not the insurance. Hold that thought. We're going to talk about that in a little bit. What if we were up here and out of the money option? Maybe it's 220. Home Depot's at 180. Anybody think it's going to hit there in 30 days? Nope. So why do you want to pay a premium for the right to walk away when we already know we're going to be walking away? We have confidence that those are going to be not exercised on top and yes, exercised down here. So market says we're not going to pay you a lot of time premium. That's the theory behind it. But what if you get right in here? Somewhere in the middle, what we call at the money. 50-50 shot. Your guess is as good as mine. I don't know. Half the time you'll be right, half the time you'll be wrong. There you're going to pay a lot of extrinsic value because we have a lot of uncertainty as to whether they will become shares of stock. So the key word is always about certainty. So is this really the way that it works in the real world? Well, here's some actual quotes from Home Depot. Again, the stock is up at about 182. And look right here. 180 strike is the at the money. How do we know that? Extrinsic value is 1240. That's the highest number in that board. This column, by the way, if you can see, it says extrinsic value. Those are your time values. And that's 1240. But look what happens as we go this direction to lower strikes. 175, 170, 65, 66, 55. What's happening? We go 10, 8, 6, 5, 4. So what happens as we go up into this direction? We're becoming more confident that those are going to be exercised. And the market says, I'm going to start paying you less and less and less because I'm becoming more and more confident those will become shares. What about down below? Going about 12, 9, 7, 6, 4. These are out of the money. We're getting more and more confident that those will be not exercised. And so the market says, well, we already know the outcome, so we're not going to pay you as much. And in fact, if we went far enough up this board, we would eventually run into zero. If we went far enough down this way, we'd eventually run into zero. Actually, not zero, because there's always going to be an asking price. But you'll run into 5 cents, and then they'll just top out at 5 cents. But close enough to zero. But the point is those extrinsic values are going to start melting away as we move deeper in the money or as we move deeper out of the money. Okay, everybody see that? So now, let's answer another pricing question, theoretical question, because this is where people get tripped up. I said it's a lot about perceptions. What is the value of the most extreme option you could ever have? And what would it be? Well, think about this. What is a zero strike call worth with an unlimited time to expiration? Now, don't go looking up on your phone on the CBOE's quotes. They don't exist. It's a theoretical question. But if you had a zero strike price, what it means is you could exercise your option, pay zero, and get 100 shares of stock. And you'd have forever to do it. People go, oh man, Jeff Bezos wouldn't even be able to afford that. What's it worth? Stock. It would be trading for the stock's price. Why? It's the very best you're going to get out of the contract. No option contract will trade for more than the price of the stock ever. Trades for $1 less, you've got an arbitrage, well, actually on either side of it. So it's going to trade for the stock's price. So another little interesting insight about this is that for all the stock traders who say, I'm going to stick with good old stock, I'm not going to mess with those risky options, guess what? You guys are options traders. What are you trading? Option with a zero strike with an infinite number of days to expiration. Well, if I really, push comes to shove and I said, are you really going to hold this to infinity? You'd probably say, no, probably more like, 6 months, a year, 2 years, 3 years. Well, then why are you buying the stock? Why are you buying the stock? You've got the most expensive option on the board, at least in terms of the amount that you got to pay for it. Okay? So the point is, as you start going to lower and lower strikes, like we saw 170, 165, if we kept going to lower and lower strikes, they're starting to get closer to what? Shares of stock. They are not becoming more expensive options. Why are they not becoming more expensive options? What's shrinking? The extrinsic value. What makes an option an option? The extrinsic value. If there's no extrinsic value in there, there's no option. It's just a down payment on the stock. There's nothing to be afraid of. So the proper perspective, just remember that as a call option becomes more in the money, it behaves more like shares of stock. And again, that's the big misperception. People start looking at those options, used to seeing $2, $3, $4, and then they're looking at things that are $20 and $30 and $40, and they go, oh, that's a ridiculously expensive option. It's not. Almost no option to it. In fact, there's also a condition called parity. Anybody know what parity is in options trading? Parity is a condition where the option is trading for purely intrinsic value, or at least very close. It generally happens very close to expiration, but it could happen if you've got 30 or 60 days, but it would have to be ridiculously deep in the money. But it's called parity, and parity is just a fancy word for equivalence. So let's say that our stock is trading for 100, and we've got the $40 call trading for 60. What is that? It's trading at parity. Why? If you paid 60 for the call, and then you exercised it and paid 40, how much did you pay for the stock? What did the stock trader pay? How can you say that you're not better or that you're worse off because you bought this risky option? Now, did it cost you 60 bucks? It's a down payment on the stock. It has nothing to do with an option at all. There's no option in the deal. That's why it's called parity. There's no option in that, and yet most people would look and say, geez, that's a ridiculously expensive option. It's not. Got to keep the perspective. That is stock. That's why it's called parity. Now, in the real world, if this was trading for $60.10, yeah, we'd still call it parity. Usually just a cost to carry in there, but as long as it's close, if you can add your strike price and the option's total price or premium, and you get very close to the stock's price, it's trading at parity. Nothing to be afraid of there. So the stock replacement strategy, what it says is that we're going to look far enough in the money so that we get lots of what? Intrinsic value and very little what? Extrinsic value, which means we're getting closer to shares of stock. We're not getting into risky option territory. We're getting into almost no option territory. We're just putting a down payment on the stock, and then we have the right to float the strike price. And if we do that, the market will treat that like what? Shares of stock today. And that's really the essence of the stock replacement strategy. Now there's an important little key phrase right there that I've highlighted. Far enough. Well, how far is far enough? We're going to go one strike in the money? Stock's at 100. We're going to go to the 95, to the 90, 85? How far in the money? That's the next big question. Let me show you what happens here. Let me show you the logic behind it. Here's our quotes again. I know it's a little hard to see in here, even on a big, super big monitor, but This is the mark. Can everybody see that, these red numbers?
Yeah.
And the mark is the midpoint, some platforms will call it the mid, of the bid and the ask. So if you add the bid price and the asking and divide by 2, you get that. So in most cases, that's where the option can get filled. That's why they show them on platforms. That's generally where you want to put your limit orders. But for right now, I just want to make the pricing easy, so I'm going to use these as my option prices. So let's say I take a look at this 175 strike down here. And I say it's trading for 1625. I could choose that one. But what if I go up one more row to the 170? Now it's going to jack up the price to 1927. That's going to increase my cost by 302. But what did I do? I also reduced my extrinsic value from 11 and change to 9. I'm going to decrease it by almost $2. Would I take that deal? Yeah, I would prefer to have the 170 over the 175 because, I mean, $2 is a pretty good chunk of 3. And I'd rather have intrinsic value than extrinsic value if I'm a stock trader. So I would prefer the 170. We'll keep with the same logic. What if we go to the next one? I can increase my cost by 323, and I'm going to decrease my extrinsic value by $1.78. Would I take that? Oh, yeah. But what you're going to find if you continue this logic all the way up the chain, eventually you're going to hit a point where you're going to increase your cost by almost the difference in strikes, 472, and what do we knock off here in the extrinsic value column? Almost nothing. You're going to hit a wall. And in fact, if we kept going, eventually we would have to pay 5 to knock off 0, pay another 5 to knock off 0, and you have to say, well, what's the point? You're hitting a point of diminishing returns. So that's why we come up with this 80 to 85 delta rule. Okay? It's not a perfect rule, and as you get more experience, you can refine it, but it's a good starting point. It'll certainly get you better than the people who go by the at-the-moneys. And the whole point is that we're going to look at our delta column, and if you find something in the 80 to 85, traders get sufficiently high deltas. Are they going to be delta 1 like the stock? No, they're going to be 80 to 85. But you're going to get a greatly reduced cost. And in fact, if you buy 100 shares of stock, I could buy 2 contracts and have 160 deltas and still spend less than you. Okay, so if you're insistent on having at least 100, you can still do it for less money. Now, there are a couple of exceptions here. The 80 to 85 I like to mention is really for long-term stock investing, like what we use for our Phoenix portfolio, which is a long-term crash-proof portfolio. But you'll see some of our products and services that we'll use a 65 delta for calls, such as for TNT options, and 50 delta for puts. And there's a reason. It's because of gamma, which we don't have time to go into here, but I just want to make that point that if you're at our booth or see on the website and you go, well, how come they're using these for stock replacement? That's really more for short-term trading. But for stock investing, where do you want to hang? 80 to 85. So let's take a look here. Now, here's our delta column. And all you have to do, there's 96, 94, boom, boom, we come in. There's about an 85 delta. And that's the one I would pick. It's a 145. However, you've probably noticed for this presentation, I'm going to do the 140. And the only reason I'm doing that is I was trying to snap it when we got exactly $2 just to make the numbers easy to work with. Okay, not trying to pull any funny stuff. I just want to make the numbers easy to work with. So for this example, I want you to pretend like we're dealing with the 140 strike. We're going to make that $2. We're going to make the options price $42.15 instead of $42. And we're going to say that the stock is exactly 180. And again, it's just to make the numbers easy. Okay, so that's going to be our pick, the 140 strike. Now, is that an expensive option? You're going to go, holy smokes, it's $42. It's outrageously expensive. Misperception. Okay, you've got $40 of intrinsic value and $2 of time. What makes an option an option? Extrinsic value. How much extrinsic value is here? Not much of an option. It's a $2. In a professional trading term, if somebody said, how much is that option? I'm going to tell you it's $2. Intrinsic value is cash. That has nothing to do with the option at all. It's just cash. So let's say if we bought the 140 call for $42 scary option price, what's my effective price or my cost basis? The stock's at 180. Well, it's a $2 option, not a $42 option. I'm just $2 off of you. And why am I paying that $2? Why am I paying that? What do we talk about? For the right to walk away. Now you might say, it doesn't look very likely that a $180 stock is going to fall below 140, and you're right, and that's why the insurance premium is cheap. You're not paying a lot for it because it's probably not going to happen. But it's still there just in case. Now, of course, if you didn't want to pay 2, what could you do? Go to the 135 strike. If that's too much, go to the 130. If that's, options give you options. You can take your pick. We just find for most people that 80 to 85 delta gives you that sweet spot. So it's a $2 option. So again, watch this. If you buy the stock at 180, and I buy this big, scary 140 call for a whopping $42, and you're going, holy smokes, that's an expensive option. Let's assume that the stock falls to 140. How much are you down? That's my strike price. You lost 40. How much did I lose? No, I lost 42. I lost the entire premium, right? Option expired, worthless. What's the difference between us? There's that $2 number again. Can't get rid of it. Why am I only off by $2 compared to you? Because that's what I paid for the insurance premium. We both lost $40 of intrinsic value. It had nothing to do with the option. It's exactly the same $40 that you lost. It's got nothing to do with the option. It's just cash. But now people say, you know what though? I got you. Because you lost 100% of your money, and I can sit there and hold on to my stock. Where in the world is the insurance policy now, Mr. Options Trader? Let me show you. Now, in the previous slide, I assumed that the stock came down to my strike of 140. But let's say that Home Depot falls to 130, shoots right through that strike. Probably not going to happen. Again, that's why the insurance policy was cheap. But let's say that it did. You bought the shares at 180, you're down 50, correct? Stock at 130. I bought the 140 call for $42. How much am I down? I lost 42 bucks. Okay? It expires worthless. And again, this is where the stock traders say, see, the option got you. I can still hold on to the stock and wait for it to rebound. And in most cases, it does. But you, Mr. Options Trader, you lost everything. Another misperception. Why? I could go and exercise my option. I can exercise for any reason at any time. And I could exercise and pay the 140 strike plus my 42, and I have a 182 cost basis, which makes me down to 52. How much are you down? 50. There's that $2 again. But now you're probably saying, but wait a minute, why would you exercise and pay 140 when the stock's trading at 130? That would be stupid. And you are 100% correct. I wouldn't. I would let it expire worthless. It's an advantage. That's my insurance policy. Watch this. I'm going to go out in the open market. I'm going to pay 130. I paid $42 for my original contract. What's my cost basis now? 172. I'm down 42. So let's switch these out right here. I'm down 42, you're down 50. Ooh, how did we switch places? How did we switch? How did I become $8 better than you? Now this is a tricky question. And this is a hard one to see. How did I get ahead of you by 8? I'll tell you. It's the insurance. But where's the insurance? Let me tell you where it comes from. Now one of the things we always like to do at the Institute, part of what I'm trying to show you is that this is not always that easy to see. And this is where your opportunities lie. But you have to understand that a call is a put and a put is a call. I know people are going, let's say that again. A put is a call and a call is a put. They're the same thing. It just depends on how we delta hedge them. So anything you can do with a call option, I can do with a put. Anything. That's why I have people say, can you do a condor with calls? Well, or with puts? Can you do it with calls? And the answer is immediate. Yes, you can. If you could do a strategy by buying a call, I can do it by buying a put. It just depends on how we delta hedge them. So mathematically, I bought the 140 put. I didn't. I bought the 140 call, but mathematically, I bought the 140 put. Because I could have bought the stock and bought the 140 put, which some of you might know is a synthetic what? Call option. There's your insurance. But let's say that I bought the 140 put. The stock's at 130. How much is that put worth at expiration? It's worth 10 bucks. What did I pay for it? Very good. I did not pay 42. I paid 2. What's it if I have a $10 benefit from my put going $10 in the money and I paid 2, how much did I benefit? There you go. That's my insurance policy. Okay? Yes, it came to my rescue. It's hard to see, but it's much easier when you understand that a call is a put, a put's a call. You're going to see so many advantages and strategies that open up that you just won't see otherwise. So let's take a look at the benefits now. First one is our cost efficiency. I paid 42 for the 140 call. Stock's at 180. We divide these out. I'm paying 23% of the stock's price. Is this an expensive option? No, $40 of that is a down payment. There's a $2 insurance policy. What if you don't like those numbers? What if you don't like the $2 premium? What are you going to do? Buy the 135. If you don't like that one, what are you going to do? Buy the 130. You can take whatever you want. Buy whatever insurance policy you want. But just don't buy the stock. But now if you go on margin as a stock trader, you got to pay 50%. Now I know you can get pattern day traders, and if you have a lot of SMA in the account, you might get 5%, but that's only intraday. I can ride this thing at 23% forever. And I will never have a margin call. You're going to get them at roughly 30% for most brokers, right? What else are you going to get? Margin interest. I've got none of that. And I can ride at 23% forever. Yes, I paid $42. Was that an expensive option? No, it's a $2 option. It's all it was. I get a higher ROI. Again, here's the numbers we just saw. 23%. I'm paying, let's round it to 25%. I'm paying a quarter of the price. And so therefore, I'm getting 4-to-1 leverage. What do you get in the stock market at 50%? 2-to-1. You got a lot of other risks in there too. Plus, it's very expensive. I've also got limited risk. A couple of little hidden benefits in here as well. Now, I think most people know that the most you can lose with an option is the most you paid. But everybody know how to read a risk graph? These are just stock prices across the horizontal right here. So this is our stock at 180. I've got these set at 20 points. But let's say if the stock goes up 20 points from 180 to 200, I find 200, I trace a line up there, and where it touches, I look over, it says I'm going to make 20. I'm just going to make dollar for dollar up, and I'm going to lose dollar for dollar down. It's a straight line. Always is. Stock. That's a risk. As an options trader, if I buy that 140, I look like this. Sometimes what we call a hockey stick graph. I put a bend right there at my strike. And I therefore get rid of all of this risk for $2. If you don't like $2, pick a different strike. But you don't need to pay $180 for the stock. And yet, if you look at this up here, they're virtually identical. Can't tell them apart. That's why it's called a stock replacement strategy. Virtually the same thing until we get down towards our strike. But we don't have to wait till expiration for this to kick in. There's another principle of options called gamma. So prior to expiration, while you're still on this red line, my curve is going to look like this. It's starting to get towards that hockey stick, not quite there, but the option is automatically going to start hitting the brakes for me, whether you want it to or not. So you hear a lot of traders say, oh, I'll do this, or I'll close it if that happens, and what happens? You never do it. The option will force you to do it, and it will do it perfectly every time. It's going to start hitting the brakes. So while you're on the stock losing more and more and more as this stock falls, my option is tapping the brakes. That's gamma coming to my rescue. It's a benefit. But it gets even more fascinating than that. To go off a little bit on a tangent here, we can even structure strategies where I can put a curvature like this, where I can put gamma to where I make more than you if the stock goes up, and I lose less if it goes down. Who would have thought? An options trader. This is gamma in action. Now, if it sounds new to you, this is why we are big believers in education. This is where your opportunities are. Okay, but these are some of the things we can do that can help you reduce losses. Diversification. Again, the same number that we saw, roughly 25%. I can buy 4 times as many similar options. So while you might have all of your money sitting in Home Depot, I've got 100 shares in Home Depot. I got 100 shares in Microsoft, I got 100 shares in, I can spread it out. I'm more diversified. If you say, well, I trade the SPYs, I'm already well diversified, fine. Then I can make your account have the same returns for putting less money into it, and that means you have cash on the side when markets dip. I don't care what argument you present, I can put you in a better position. That doesn't mean it's always profitable, but I can put you in a better position than when you're trading just shares of stock. Finally, we get the ability to roll. What is this? Well, you're going to just sell your long option, and we're going to buy the next higher strike. We're going to do it as a simultaneous order. And it's actually a credit spread, at least for the calls. So in this example, we're going to sell our 140 call. We're going to buy the next higher strike, the 145. And we will generally get a credit of 4. One of the things we teach at the Institute is you want to get roughly an 80% of that difference. And there's a lot of theoretical reasons why we do. We don't have time to go into it. I don't want to do a credit of 50 cents or $1. But I want to take about 80% of this difference in strikes. So 80% of 5 is 4. So, and I can put that order in right now. I could have bought my call option and put this order in and let the computer handle it. What's my cost basis now? I paid 42 for the initial contract. I subtract off 4. I've now got $38 into it, but I still have my 100 shares. As a stock trader, what do? You watch your unrealized gain go up and up and up and up, and there's nothing you can do unless you sell. I can sweep cash off, and I can maintain that position forever. Now, you might say, well, I could sell off some shares of Home Depot. True, but eventually you're going to hit 0. Home Depot could run from 180 to 18,000, and I'm just going to continue to roll with it. I never, ever have to let go. I just roll. And so I'm going to move from this profit and loss diagram to this. I'm just shifting up. I'm reducing the amount that I can lose. Now you might see that it shifted out a little bit. It's a classic trade-off. Why? Mathematically, we paid $1 for the put. It's a little insight why we like to take 80% of that difference in strikes. It's a trade-off. It's a classic hedge. What options were designed for. Roll number 2. Stock keeps going up. I'm going to sell my 145, buy the 150, credit of 4. Cost basis is now reduced to 34. I've now gone from the green to the red to the blue. Still have my 100 shares. I'm just going to keep reducing the risk. And now I've got this credit sitting here, so if it pulls back, I could actually put more into the markets.
It is still delta 85?
It would still be very good, still be delta 85. There are some other strategies we teach, like over-rolling, and there's times that we might want to change it, but for yes, right now you would keep that delta at 85. So your initial option might go to a delta 92, and then we're going to bring it down to an 80 to 85, correct. So you're always maintaining that. So everybody see that? One of the most powerful benefits you can get with options. Now the final one I want to point out here, which is one of the more fascinating ones to me, is the insurance cost benefit. And I know it's kind of hard to see in here, but now this screenshot was shot a little bit later, so the prices aren't exact. But look down, can you all see the 140 strike right here? The extrinsic value there is what, $1.26?
Can you put Apple? Can you trade Apple now?
What's that?
Can you trade Apple?
Oh, sure. Oh, yeah, you could do it on any. Oh, no, I can't pull. I don't have a platform. These are screenshots. Yeah, I wish I could. But did everybody see that that's trading for the extrinsic value is $1.26? Trick question for you, quiz time. How much is that option? Now, novice now is going to tell you it's about $42. How much are you paying for the option? No. How much are you paying for the option? Thank you. It's a $1.26 option. And theoretically, if you put this in a Black-Scholes model, the 140 put would be trading for the same, if interest rates are the same. The 140 put would be trading for exactly the same extrinsic value. But take a look at here. I said you could buy the stock plus a put. What is the market valuing the put? $3. The market says the insurance value is $3, and we're getting it for $1.26. We're getting it for half price. And this is what's called a put-call skew. And if you know where to look, these are where the opportunities are. Now again, like I said, what if you don't like to pay $1.26 for the insurance? Go up to here for 53. How's the market valuing it? 245. We're getting the insurance for 53 cents. You don't want to pay that? You want to pay 4 cents? Fine. You're still getting benefits. Market's valuing that insurance at $1.66. And you're going, why in the world would you ever trade the shares? Tremendous amounts of benefits. Okay, so I hope that that gives you some things to think about. And as economist Michael Porter said, the essence of strategy is choosing what not to do. So I hope that you at least learned the one thing you don't want to do is to buy the stock. And if nothing else, I hope it helps you to keep the perspective. Any final questions? Kind of right at time there. Yes?
Now that cash is worth a little something again, this is starting to change all this pricing.
Yes, it is. The question is because we're starting to get some interest rates that are above zero, and it does change it, but that's also coming out in the wash with the call. Because theoretically, by buying the call, you're going to be paying a cost of carry on it. That's why I said the call and the put will trade the same if interest rates are zero. But if not, they're going to be trading for the cost of carry. So you're going to be trading for that, and theoretically, that's what you're saving by leaving the cash in the money market. Now, I know in the real world, the amount you're getting as interest is not going to be what you're going to be paying in there. But yeah, I mean, you're still going to pay the cost of carry in the call option. Anybody else?
Are we going to get copies of the slides?
I don't know if we can do copies of the slides. Oh, and also one last thing here too. If anybody wants more information, please see melanie.ryan@investitute.com. There's Melanie back there. Say hi, Melanie. Say hi to Melanie. So if you have more questions, she would be more than happy to help you with court.
This is on moneyshow.com.
I'm sorry?
Moneyshow.com. If you want to watch it.
I believe so. I think they said it's being recorded. Yes. So it'll be sure. Any other questions? Welcome any questions. Love talking about this stuff. Anybody? Everybody good? Okay. Well, I want to wish everybody a fabulous rest of the day. I guess it ends today, and have a safe trip back. And